All right, so as some of you know, or may remember, I'm out this week at a business conference in Denver. So we're going to do the first half of this, first week, in which I'll do the first half of this, part A of chapter 15, in a recording here, and then we'll meet up in week 2 to finish up chapter 15 and start chapter 16. Hopefully I remember all this since I haven't looked at it in like 24 hours, and I'm telling you, some of it's kind of hard to keep together, but most of it really isn't. It's just a couple of little things. Anyway, all right, so what is a lease? Well, a lease is an agreement, a contractual agreement between the lessor, the person who owns whatever property is being leased, and this could be real property, this could be personal property, between the lessor, the owner, and the lessee, the user of the property. What the lessee gets out of this lease is the right to control the use of the asset, exclusive use of the asset, and in return, the lessee pays the lessor periodic cash payments, usually once a month, but sometimes quarterly, semi-annually, or annually. I'll let you look at this advantages of leasing. It definitely does provide some advantages, but I'm not going to spend a lot of time on it. Anyway, that's on page 834 and 835. There are two types of leases. It used to be there was just one type, the operating lease. And if you had a lease, you could keep the asset off your balance sheet, even if the lease was really nothing more than a disguised purchase. And so off balance sheet financing used to be a big thing. That's what got Enron into some hot water and bankruptcy and collapse. So now, as a result of Enron and maybe some more, I'm sure that other companies were abusing this as well, this off-balance sheet financing. Uh, FASB made some changes to where they created two types of leases. The finance lease, otherwise known as a sales type lease, looks for all intents and purposes like a sale. Operating lease, not so much. So we'll talk about those things here. We're going to start out with the finance lease. And so a finance slash sales type lease is must be reported as such if it meets one of the 5 criteria, at least one of the 5 criteria. Number 1, the agreement specifies that ownership of the asset transfers to the lessee. That seems pretty logical, right? That if the lessee is going to own it at the end of the lease, it looks like a sale. Number 2, the agreement contains a purchase option that the lessee is reasonably certain to exercise. The book notes that or calls it a bargain purchase option, meaning that the fair value of the asset is more, and usually it's quite a bit more, than the bargain purchase option. If it is, then it's the lessee essentially would be foolish not to exercise the bargain purchase option, because they could turn around and sell the item for its fair market value at a gain. So makes sense. Number 3, the lease term is for the major part of the remaining economic life of the underlying asset. If they're getting all the benefits for the major part of the economic life of the asset, then sure looks like a sales type lease. And like a purchase. Number 4, the present value of the lease payments equals or exceeds substantially all of the fair value of the underlying asset. And of course, substantially all, and in number 3, the major part, are terms of art. We have to go deeper for guidance. Number 5, the underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease. So you've got a custom job here involved. Nobody else can use it, certainly not the lessor or anybody else, probably. All right, so here we have an example. On January 1, 2018, Sans Serif Publishers leased printing equipment from First Lease Corp. First Lease purchased the equipment from Compudec Corporation at a cost of $479,079. The lease agreement specifies 6 annual payments of $100,000 beginning January 1, 2018, the beginning of the lease, and at each December 31 thereafter through 2022. The 6-year lease term ending December 21, 2023 is equal to the estimated useful life of the equipment. The price Sans Serif pays for the right to control the use of the equipment is the present value of the lease payments, just like in a sale or a purchase. If funds were borrowed to buy the equipment, the interest rate would have been 10%. How should the lease be classified? Well, simply go down the list. It's pretty clear that this is a sales type lease, because the fact that the lease, the present value of the lease payments equal its fair market value. Not only that, but the 6-year lease term is equal to the estimated useful life of the equipment. So there's the present value of the lease payments, same as the fair market value. So number 1, does the agreement specify ownership of the assets transfers to the lessee? No. Does this agreement contain a purchase option that is reasonably certain to be exercised? No. But like I mentioned, 3 and 4 are met. And so therefore, you must classify this as a finance sales type lease and report it as such. Now, when we account for this and report it, it's very similar, but not exactly the same as the sale and purchase type situation where we have a promissory note. So we'll see that here in a second. All right. Am I going backwards or what? What's going on here? All right. So anyway, the journal entry for the lessee, sans serif, is debit right of use asset for the present value of the lease payments, also the fair market value. And of course, the credit is lease payable. So instead of note payable, lease payable. Now the lessor just has the flip side of this. They have a lease receivable that they're going to record as a debit, and then they're going to take and remove the asset from their balance sheet. So they're going to credit equipment for the cost of it. When sans serif makes their first payment, they're simply going to debit lease payable and credit cash. And of course, first lease just simply records the cash and reduces lease receivable by $1,000. Now, the first lease payment, notice that the first lease payment is made up front, okay? So it reduces the amount of the balance from 479 to 379,079 immediately. And of course, it reduces the receivable for first lease by $100,000 down to 379,079 or whatever that was. Yeah, 479 down to 379,079. And so the second lease payment is made at the end of 2018. Well, 1 year's worth of interest has accrued now on 379,079. And so the first payment, of course, like you learned in chapter 14, when you're dealing with sales purchases on notes payable, the first, or at least the second payment in this case, has both an interest expense component and a component that reduces, in this case, the lease payable, not the note payable. And so we simply take the outstanding balance at the time of the payment, 379,079 or 379,908 in this case, rounded, and multiply it by our effective rate, which is 10%. So that's going to be your interest expense, and then the difference between 379,008 and $100,000 is, of course, going to be a reduction in your lease payable. And of course, the next time you do this, the third lease payment, that's going to reduce lease payable, therefore it's going to reduce the amount of interest expense, and increase the amount of lease payable that's going to be reduced. As far as the lessor, they just take the flip side of this. They they record the cash as debit. They reduce their note receivable or lease receivable and record interest revenue for the same amount that sans serif recorded as interest expense. And of course, you have this amortization schedule that should look familiar for each one of the payments. So very similar to a note payable, note receivable. Just call it something else, but the handling of it, pretty much the same. On top of, let me get caught up here. On top of everything I just showed you, the lessee gets to record amortization expense. What? Amortization expense? Yeah, this is something new. Neither party gets to record depreciation expense because, well, I'm not sure why. I don't have a good answer because, somebody made the rules, not me. Somebody else made the rules, not me. So what they decided to do was, well, at this point, the lessee doesn't own it, but they have the exclusive use of the asset, thus the term right of use. I mean, if they owned it outright, they would depreciate the asset, right, over its estimated useful life. Well, they don't own it yet. Well, they don't have a bargain purchase option, and it doesn't become theirs at the end of the lease. So, I mean, under these lease terms, they're not going to own it. But, and so I guess FASB said, well, nobody can depreciate this, neither the lessor or the lessee, but it seems like since the lessee has the exclusive right to use it over a significant portion of its useful life, they should be able to do something like depreciation. So they called it, well, let's let them amortize, which has the same effect as depreciation, right? It reduces the book value of the asset, in this case right of use asset, over its useful life. So it's exactly what we're doing here. It's just like depreciation expense, except they call it amortization expense. And so the debit each year for the next 5 years is going to be amortization expense, debit, right of use asset, credit. And so it's the right of use assets book value is going to decrease by 79,847 in this case. Notice this is simply a straight line approach. So there's no flexibility on this. They can't use an accelerated approach to amortization. It's simply a straight line approach. Now, you can have, in the example we showed, the lease was for the same amount as the fair market value, plus on top of that, First Lease didn't produce the item. They didn't manufacture the item. They just bought it from the manufacturer and turned around and leased it. So there's no cost of goods sold that would be different than the sales price. Well, what if the manufacturer sold directly to sans serif? Well, in that case, you're going to have two components. You're going to have the actual lease, and you're going to have a cost of goods sales component. And so, this is simply a variation of what you've seen before. Not that big of a deal. So again, it occurs when the fair value of the assets exceeds the cost or carrying value. The lessor recognizes a selling profit at the beginning of the lease term. The lessee does nothing. They simply record the same stuff you just saw. The lessor also recognizes interest revenue over the lease term, just like you saw. So here's some disclosure notes. Not sure why that's in there, but anyway. All right, so let's look at an example of this. On January 1, 2018, Sans Serif Publishers leased printing equipment from CompuDoc Corporation. So CompuDoc is the manufacturer. The lease agreement specifies 6 annual payments of $100,000 beginning January 1, 2018. Basically, bottom line, it's the same lease, except this is not First Lease or whatever it was called. The lessor is CompuDoc Corporation, which is the manufacturer of the leased printing equipment. So they have a cost of manufacturing this printing equipment. So same terms, except the following. The 6-year lease ending is December 31, 2023 is equal to the estimated useful life. Yeah. So same there. CompuDoc manufactured the equipment at a cost of $300,000. That's the key difference. All right, so using an interest rate of 10% for financing this transaction, CompuDoc, or DAG, calculates the present value of the lease payments to be received as $479,079. Now notice here, they're using, to figure out this present value, they're using, and this is true when you look at the tables in the back of the book, or when you're doing this on Excel. You're not going to use present value of an annuity when calculating the present value. You're going to use present value of an annuity due. Well, why is that? The reason why is because there's a payment up front at the beginning of the lease, not at the end of each period in the lease. Okay? Recall that we're getting a $100,000 payment at the beginning of the lease and yearly after that. So keep that in mind. It's not that big of a deal, but your numbers will be off if you use present value of an annuity rather than present value of an annuity due. Okay? So here is going to be the entry. Cost of goods sold is your debit. It's an expense. Lesser's cost. And of course, they're taking the equipment off the books as they did before. At the lesser's cost, not the fair value. And of course, the rest of it, lease receivable 479,079 and lease revenue or sales revenue is the same. Well, I take that back. That credit is not the same. Notice it's sales revenue. And in the case of our first example, what did they do? Well, the initial recording of the lease was debit lease receivable, just like it is here, and credit equipment for 479,079. Well, here, and the reason why is that Lease Corp had it on their books at the cost, which is the same as the fair market value they bought it at, which is also the present value of all lease payments, the lease receivable. Here, you've got the manufacturer doing this entry. Well, their cost of this is not 479,079, it's 300,000. So they take off the equipment off their books with a credit of $300,000. And so basically it's a plug number plus, I mean, think about this, down at the bottom, that's the entry that a manufacturer is going to make anyway, right? Sales revenue minus cost of goods sold equals their selling profit, gross profit, right? So just note the difference. Subtle but important. First payment, which is like the same day, same as before. Now note here, when there's a selling profit, all the lesser entries other than the entry at the beginning of the lease to include the selling profit are precisely the same as the entries for a sales type lease without a selling profit. The lessee's accounting is not impacted by whether or not the lessor recognizes a profit. So they don't have to do anything. This affects the lessor, not the lessee. So the journal entries made by the lessee are precisely the same with or without a selling profit for the lessor. And so they just kind of extend the example here to make sure they're driving home the point. Let's say you purchase a TV from Best Buy for $479 and pay for it with your Best Buy credit card, and assume Best Buy paid the wholesale price of $300,000 to Samsung to acquire the TV. Here's the way Best Buy would record the sale. Well, it's a two-part thing, right? Accounts receivable, debit, 479, sales revenue, 479, cost of goods sold, 300, inventory, 300. So, gee, that looks familiar, right? just not as many zeros on the end. So it's basically the same as what we've seen before. I mean, we could have simply done it this way and not made it a compound entry, but why? And if that's the way you want to do it, that's fine. I mean, it's same effect. If you want to do it the second way, that's fine. It's not going to get you fired. All right. Operating leases. If none of the 5 conditions that we talked about are present for a finance lease, well, then it's going to be an operating lease and be reported as such. And so the fundamental rights and responsibilities of ownership are retained by the lessor. The lessee merely uses the asset temporarily. A sale is not recorded by the lessor. The lessor records the lease revenue on a straight line basis. The lessee records the right of use asset and lease payable at the commencement of the lease based upon the present value of the lease payments. Now, what you're going to see is because none of the criteria for a finance lease exists, then it's going to be a shorter period of time, less money owed over the lease period. Moreover, the lease payable is considered a non-debt liability on the lessee's balance sheet. So they have to segregate that out so that they don't break any debt covenants that might exist with their lenders. All right, so here we have an example, kind of like the others. On January 1, 2018, Sans Serif Publishers leased printing equipment from First Lease, so we're back to First Lease as the owner of the equipment. First Lease purchased the equipment from CompuDeck at a cost of $479,079. Sans Serif's borrowing rate is 10%. Lease agreement specifies 4 annual payments of $100,000 beginning January 1, 2018, balance of the lease, or the beginning of the lease, and at each December 31 thereafter through 2020, not 2023. The useful life of the equipment is estimated to be 6 years. So now it's just 66.2 or 66 and 2/3 percentage of the useful life of the asset, which is under 75%. Oh, that's important to know. Let's talk about that. This didn't really get into that. Okay, so what are those terms of art? Major part. Okay, criteria 3. Okay, so third criteria considers whether the asset is leased for the major part of its useful life. Guidance indicates that one reasonable approach to assessing this criteria would be to include or conclude that 75% or more of the remaining economic life of the underlying asset constitutes a major part of the remaining economic life. Okay, so here in the first example, as well as the second, it was for the whole economic life, 6 years of it. So 100%. Here you have 2/3, so that's less than 75%. So it's less than the remaining economic life of the underlying assets. So it doesn't constitute a major part of the remaining economic life of the asset. Okay. The other thing is criterion 4. So that talks about if the lease payments have a total value that represents substantially all of the asset's fair value. Well, and that's guidance suggests that payments with a present value of 90% or more of the present value of the asset represent substantially all of the fair value. Well, here I'm not going to do the math on it, but this is definitely less than 90% of the present value or of the fair value of the underlying asset. So for criteria 3, 75% of the remaining economic life. Criteria 4, it's got to be 90% or more of the fair value of the underlying asset. The payments have to be the present value of more than 90% or more of the fair value of the underlying asset. Okay? I thought they were going to address that, but they didn't do that. All right, so back to operating leases. All right, so here the present value of the 4 payments of $100,000 equals $348,685. Again, because there's a payment made, down payment or a payment of $100,000 made immediately, this is a present value of an annuity due, not a present value of an annuity calculation. So here's the initial entry by the lessee. Notice that the lessor makes no entry at all initially to record a receivable or to, in their words, de-recognize an asset. And so the lessor does not take the asset off their books, and it must depreciate, or it gets to depreciate that asset over its useful life. The first payment, of course, is no interest has accrued, so it's simply on the lessee's books a reduction of lease payable and, of course, a reduction in cash. For the second lease payment, you're going to have less interest expense because you're starting off with a lesser balance. Rather than $379,079, it's going to be the initial present value of the lease minus $100,000, or $248,685, rounded up to 20 at 10%, rounded up to $24,869. And of course, you're going to credit cash for $100,000. The difference, the plug number, is a reduction in your lease payable, in this case $75,131. Well, lo and behold, the lessee also gets to deduct amortization expense. Now, they record this on their books as two different expenses, but as the book notes, for presentation purposes, they combine the two into one item, in this case for $100,000, the $24,869 plus the $75,131. So the amortization expense is simply going to be the amount of the payment minus the interest expense. And of course, that's going to reduce as your credit the book value of the right of use asset. And so like I said, you're going to combine these for presentation purposes on your income statement. The combination of the interest expense plus the amortization expense as one expense called total lease expense of $100,000. And so for amortizing this, it looks like this. So in the second year, they're going to pay $100,000. You're going to have interest expense of $17,355. You're going to have amortization expense of $82,645, and those two things are going to be combined to be your total lease expense for the year. Same for year 3. So they get off into this. Amortization reflects in a finance lease the right to use the asset and the financing of the right, whereas the lease under an operating lease, the lease expense is recorded in a manner designed to mirror straight line rental of the asset during the lease term. If you don't understand that, I'm not sure I do either, so I guess it's really not important if we don't understand it. But anyway, there's a comparison of the lessee's expense recognition. All right, so next time we will talk about, want to talk about short-term leases. If the lease has a maximum possible lease term, including any options to renew, of 12 months or less, this is considered a short-term lease, and so the lessee does not have to recognize the right-of-use asset or a lease liability. They simply recognize lease payments as expense when occurred over the lease term. And of course, that's going to be your debit, and of course, credit's going to be your cash, right? And for the lessor, they're still going to have the asset on their books and depreciate as usual. They're not going to have any initial entry. The only entry they're going to have is the periodic payments of rent. So they're going to debit cash and credit rent revenue. So pretty easy. So here's an example of that. Leasing printing equipment from First Lease. The lease agreement specifies 4 quarterly payments of $25,000 beginning January 1, 2018, the beginning of the lease, and at the first day of each of the next 3 quarters. Useful life of the equipment is estimated to be 6 years. So no initial entry at the beginning of the lease, since the term is 1 year or less. This is exactly 1 year. Kind of have to read that into it. And then when lease payments are made, you simply debit lease expense here for $25,000 and credit cash for $25,000. Simple as that. All right. So anyway, next time, this will be live with chapter 15, part B. So we'll talk about some other stuff dealing with leases. All right.